How do you know if the price is going to continue going up? How can you tell that the uptrend or downtrend has ended? There are a lot of indicators in crypto and in every other market, but what stands out that have been working for the past 200 years are candlesticks. So, candlesticks are supposed to be your primary indicator. Any other thing or indicator is only supposed to be a confluence to what you think the candlesticks are telling you. So if the RSI indicator is very high on the daily or on the 4-hourly, but you have a confirmed inverted hammer, the price will continue to go up. Now, what do I mean by confirmed? That's exactly what we want to know in this video. For the past years, Bitcoin has been following a lot of indicators to the T. In fact, the stock-to-flow model by Plan B was just recently invalidated. But why? Why did that happen, you might ask? Because Bitcoin has never been in a period of war, recession, or pandemic. Now, I'm not saying that we are in a recession already, but I think we could be. If you watched my video on what is a recession, you will know that before everyone realizes that we are in a recession, we would have already been in it for at least 6 months. So it won't come as a surprise to me that we are in a recession already. So let's jump right into the candlestick, shall we? So before we go right into this, it will be nice that I do a bit of a recap on what candlesticks are, how they start, and everything like that. So we have green and red candlesticks. Yeah, green means the price is going up, red means the price is going down. Just normal stuff. So green is good, red is bad. Well, red can also be good if you are making profits from red. So we have a green candlestick like so. Yes. Now, so this is the body of the candlestick and these are the wicks of the candlestick. Okay, and we have a red candle like so. So this is the body and this is the wick of the candle. Now, what you have to understand here is the markets. So I'm just going to take that out. The markets always begin somewhere here. So if we're using the green, the hell. All right. So the markets always begin somewhere here. Yeah. Now, if the markets start in the green and it's going up, it means buyers, people are buying. So price is going up. Yes. So we have something like so. So this is what you would see. You will see a lot of green like so, and the candle is going up and you are making profits while this happens. Conversely, the markets could start with red and the candle is going down like so, and so you have this, all of this will be red and you are losing basically. Now, when you see something, now I have a complete beginner's tutorial to technical analysis. I will also leave the link up here, which you should watch because I've talked about all of this in that video. All of this has been explained to the most simplest form on the internet. So do your best to watch that playlist because it will go a long way to help you. If you follow me on Instagram, you will know that I always make calls, and sometimes people ask me, even on TikTok, is it too late to get in? Even here on YouTube, I still find some people leaving in my comments, is it too late to invest? And so you ask this question because you don't know when to invest. You don't know how to know if it is late or not. And so you need to understand candlesticks, you need to understand market structure so that you know when exactly to invest or when to take profits. If you don't understand this, you will find it very difficult to invest or even to take profits. And that's how a lot of people lose. People lose not because, well, they don't know how to invest, because investing simply means you go exchange money and you hold some coins. When it goes up, you sell. That's it. But what you fail to understand is how the market works. You can only know how the market works from candlesticks because this is the only way you can get that information. And this is the most trusted way you can get that information. All right, so we are going to talk about filling candlesticks in this video. If, for instance, you have a candle that starts like so in the green, it goes up, and closes up here. Yeah, so this was an extremely bullish candle, which means people only got in here, the markets, and they all defeated the sellers. There were little to no sellers, and people bought, and the price rose until here, and the market closed here. Yeah, now it can also happen that these people get in the markets here, buy until somewhere here, so the candle continues like so, and the same people start to sell, or sellers come into the market. People who are more bearish, who would want to sell, they come into the market and they start to sell, and they reach somewhere here. So you are left with a candle that looks like so. Now this type of candle is called an inverted hammer. So it's simply a hammer. A hammer looks like so. Yes, this is how a hammer looks like. So this is a hammer, this is an inverted hammer, and it is an extremely bullish candle. Actually, this candle, candlesticks are digital representations of what is actually going on in the market. So you could actually explain this in plain English. So if I was to explain what this candlestick is saying here, what I would say is the markets started here, people or investors started to buy, they bought until here, which you can see in this candle, which we can, so let's call this candle 1 and candle 2. So people, or say investors, invested and they bought, and as they buy, price increases. So as the demand increases, price increases. Normal economics. So the demand increased until here, and so when they arrived here, the same people or different people who were more interested in selling, they started to sell, and the price came down until here. But then these sellers were not strong enough to push the candle right down to here, or say to push the price right down to here. As you remember, I said the price starts here. So if they pushed past this place, that is, if the price came down, instead of having this, if the price continued to come down, so you will have an image that looks, instead of this, which is candle 2, let's put that here. So instead of this, which is candle 2, you will have something that looks like this. Yeah, so assume that the price went up and started to come down, and as it came down, it leaves the wick behind. So the wick gives you a lot of information. When you see a candle like this, well, it just tells you that the market is very bullish, but it cannot really tell you to what degree the market is bullish. This with the wick gives you a lot of information, because it tells you that there were two sides and this is how it went down. So if it happened that the price came down until here, it means that the sellers were strong enough to push the price right down here rather than in this candle. Now, but if they pushed the price down past this region where the markets opened, then you will see a candle that looks like this, because as soon as they pass that region, the candle turns to red, and so you will find something that looks like this. And if they continue to push down, that is, if people continue to sell, you will find something that looks more like this. All right, so this is how the whole stuff, this is basically the evolution of how this happens. So you would find something that looks like so if the sellers actually won. So this, let's call this candle 3. Yeah, so you would find something that looks like so if these sellers that were pushing down the price, that left it like this, if they won, if they had to win, then the candle will be at least like so, or something that looks like this, just like this, which means they just crossed this line by, say, an inch. I'm trying to explain this in the simplest way possible, which is why I might sound a bit funny, but that's how simple I can explain it. All right, so when you see this candle, this now tells you that the sellers came in, they pushed the price down, but they could not defeat the buyers. They could not defeat the buyers, and that is why you have a candle that has say half, you have like half this, half body, and half wick. You can have a longer wick or a shorter wick, but usually you will have this, and this now is called an inverted hammer. Now this can happen at say in an uptrend. Yeah, so if you see this in an uptrend, and this now should tell you if the markets will continue to go up. So how exactly do you know if this is confirmed? By the next candle. So if the next candle looks like so we have our inverted hammer like this. So we have our inverted hammer like this. So you have something like so. So this candle started here and closed here. Started here, came down, that's the seller sold, it came down here, it came right back up here and came down here. Yeah, and the markets closed here. Yes, so but the market started here, so as it comes back up, it leaves this wick down here, and so when it came back up here, the sellers pushed the price right down to here and the markets closed here. So we have a bullish candle because the buyers won. It has a larger body than the wicks, so the buyers won. And then the next candle, the sellers actually get to win, but you have a smaller candle, so you call it a spinning top. Yeah, so you have a smaller candle like this, but it's red, which means the sellers are winning. Here this are sellers. No, here you have this buyers in this candle. So let's just name this candle let's say A for this candle, you have B for this candle, and you have C. All right, so the price starts here, it goes up until here, which means these buyers from candle A are in control in candle C. The price goes up until here. The sellers in candle B come into candle C and they start to sell, and so the price comes right down here. Now here is where we know who is winning or who has won. You get the sellers here, they can't push the price past the area or the zone where the markets started, so the markets will start here. This is the point where the markets begin. Yeah, so if this was a 4-hourly candle, for example, so let's say this is on the 4-hourly. In this candle, the market started up here, went up, came down here, and closed here. In this candle, the market started here, so let's put that like so. Started here, went down, went up, and closed here. So let's say this is our close. This is the arrow is for the start and the 0 is for the close. Now in the red candle, the market started here, came up and came down, the buyers bought, and then the markets closed here. All right, now in this candle, the markets started here, went up, that's the buyers went took the price up. So as more and more people are trying to buy the same thing, its price increases. In my next video, I'll be talking about liquidity so that you understand why when Bitcoin goes up, other coins also go up. You know, it's not like many people are going to invest in those other coins. No, it's liquidity that is pushing the price of those other coins up. It is in situations where you have people investing in some particular coins that you see their prices go up more than others. So you will see, you will get a situation where Cardano is up, say 50%, and Polkadot is only up 4%. Now, the 4% in Polkadot means that it is the liquidity of the markets that is pushing its price up. It could be that you have some few hundreds of thousands of investors that are investing in Polkadot, but the volume alone should push its price more than 4%. It's a smaller altcoin than Ethereum. So it's the liquidity that basically pushes the price of the market up. And since Bitcoin has most of that liquidity, Bitcoin controls the market. I'll make another video for this. But so what we are seeing here is more people are trying to buy the same commodity, or they're trying to buy the same asset, that is Bitcoin, for example. So let's put BTC somewhere here. So as more people are trying to buy Bitcoin, the price comes up here. Now the sellers from candle B, the buyers from candle A are in control here. That's what we assume. The sellers from candle B come into candle C and they start to push the price of candle C. That's they start to sell. And as more people are trying to sell, more people are trying to sell at lower prices. It's like having, say, having anything, and you're trying, say, having a pen, and another person is having another pen. As the two of you are trying to sell the same pen, well, you'll be willing to sell at a lower rate than the other person so that you're more competitive. This way, the price of the pen itself goes down. Yeah, but if it's a market where you have a lot of demand, you'll be trying to sell at a higher price, so the price of the pen goes up. You will understand all of this in my other video, in my complete beginner's guide to technical analysis, plus my Binance tutorial. I talked about this stuff a lot. So you basically have this candle where price has been going up from candle A. That's the buyers here have been pushing up the price, and say other people who also come into the markets, they see how the price is going, they have that FOMO, they want to buy, and so the price continues to go up. Now when the sellers from candle B come into candle C, the price start to go down because they start to sell. And so as more people see the price going down, they are also setting limit orders that are lower than the one that they see, because they want to get filled in quick. You know, if the prices are going down drastically, you want to sell as quick as possible so that you are out of the markets. It becomes a competition to sell. And so in some scenarios, when BTC is crashing massively, you will even set a selling order, a limit order to sell your crypto, and it takes some time to sell because there are not much people who are trying to buy. All right, so as the sellers here sell and they reach here, they can't continue to sell because maybe maybe the price will continue to go up later, so let's stop selling now. And so that's just how the psychology of the markets work. And so some of the times, even you might decide to sell only 70% of your coins or 30% of your coins because you think it might go higher. That decision is represented in these candlesticks, and as many people make this decision, they are all represented in these candlesticks. Now this is happening in an uptrend. How do we know if this uptrend is going to continue? Because we know that this in itself here is a bullish engulfing pattern. So this right here, can also be seen as a bullish engulfing pattern because the body of this candle completely engulfs the body of this candle. I know it's not really perfect, but let's assume it is. So you have the body of this candle completely engulfing this body right here. So this is a bullish engulfing pattern. But how do we know if this is going to continue? We saw the selling pressure from here. How do we know? You confirm this with the next candle. Now the next candle will most likely start with the red, so the price will start somewhere here. This one closed here, so the price starts here. If it's a red candle and it closed here, the price will start down here. So since this one closed up here, the price starts up here. So this one will most likely start in the red because you still have this selling pressure. Some people will be like, maybe it will go down, so they start to sell, and the price comes down like so. Now this in itself will scare a lot of people. Will be like, oh, maybe I'm losing my money. They will start to run away and they start to sell. But no, the candle reverses and you have something like so. You will have something that looks like this. Now so you will have a wick down. Yeah, so the candle went down. Yeah, so as we said before, the markets, if the markets start here like here, and the candle, the price goes down, as it comes up, it will leave a wick down. That wick tells you what the price action at that time was. So if the markets go down and continue to go up and closes here like so in this candle, even if it closes like so, so far as this body of this candle, and this is really something that you will use and it will make you a ton of money, believe me. It will save you a ton of money and it can make you a ton of money. If this body here fills this wick here, which means if this wick here is not left alone, as in it is not like something like so, so you have this and you have a body like this, it is not filled. So if you don't have a body up here where this wick is, then that candle, this wick is not filled. If you have a candle like this, be aware of a reversal. Even if you have this candle like so, if you don't have the body up here filling this here, be aware of a possible reversal. If you have this candle, and this is candle C here, so this is candle C here. So if you have this candle here and you have a red candle instead, so let's say the price, as the price came down, it instead painted a red spinning top like so. This is a confirmed reversal. This price is 90% sure to go to the downside rather than the upside, because it means that the sellers from candle B came to, let's say this now is candle D. It means that the sellers from candle B came to candle D and won. It means that these sellers that were here have won and they are now in control of the markets. This, my friends, is marked as a reversal. This is marked as a reversal. Of course, you have to verify with every time frame. If it happens on the 4-hourly time frame, know that you will be seeing a possible reversal in the next coming 4 hours. So if you're having it in the lower time frames, there could be a possible reversal in the lower time frame. So you have to always cross-check with your time frames, and I've talked about that in my complete beginner playlist to technical analysis. So this is what you have to have in mind, this issue of filling the candlesticks. So if you have a candlestick that looks like so, and then the next candle comes like this candle has been filled, which means this wick here has been filled, and this candle, the next candle now, this means we are most likely to go to the upside. Now, I will show you what I'm talking about here in a bit. We are most likely to go to the upside. This you should always have in mind. It means that if the next candle after this, so this of course is candle D. If candle E, for example, comes and it is starting to paint, say, a red signal here, this to me is buying the dip. This is trying to tell me buy the dip. Now, you have to understand that candlesticks can only give us as much information. So all of this, you still have to use some other indicators to verify, but most likely we are looking at a reversal if there is no filling of this body here. If there is a filling, it means that this bullish candle here is confirming that the buyers are in control. This means we will have price action going to the upside. If this right here starts out as a red candle and you have something like this, so you have the price action coming down in the red, and so you have something that looks like so, this to me is telling me buy the dip. And so when I buy this dip here, it is most likely that the price will reverse and continue to the upside, and so I will have my bullish price action, and so I will have another candle that continues to the upside like so, until the price again is tested up, and then a reversal comes into play. If I see a candle that looks like so or like so, so this right here is telling you that there is indecision in the markets. The buyers don't know if they should continue pushing the price up, and the sellers don't know if they should take the price down. This is telling me there could be a reversal. So if I see this, I'm already taking out a lot of my investments out. And so if the price continues to go up, I wait for a dip somewhere and I invest. But if I see this, it tells me take your profits out. Now, of course, again, this depends on the time frame. So you always have to verify all of this with the time frames you are looking at. So that is basically what I mean when I say filling the candlesticks. If the candlestick of any given candle has not been filled, then you have a very high chance of the markets, or say the trend, reversing, especially on the higher time frames. On the lower time frames, anything can happen. And pro tip, the wicks of the bodies in the higher time frames are the bodies in the lower time frames. So what you see on the higher time frames as wicks are actually bodies on the lower time frames. So that tells you how increasingly volatile lower time frames are. So thanks so much for watching the video. I hope you did enjoy it and I hope you did learn. I do have links to the exchanges I use in the description. A lot of people always ask me what exchanges or brokers I use. Use the links in the description and sign up. And I will see you in the next video.